Hi everybody, my name is Griffin Bridgers. Today I'm here to discuss some new proposed regulations dealing with the anti-clawback mechanism of the estate and gift tax basic exclusion amount that if you're a practitioner in this area, you're going to want to know about because it can affect your clients and potentially your gifting strategies. As always, before I get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, before we get started, I think it's helpful to lay the groundwork. Some of you may already know the mechanisms behind the estate and gift tax, the applicable credit, and the anti-clawback mechanism. But for those of you who don't, it's important to get the lay of the land. Now, for gift and estate tax purposes, everybody has a basic exclusion amount, which is currently $12,060,000 for 2022. That amount indexes for inflation and is adjusted typically upward every single year. However, under the Tax Cuts and Jobs Act, that basic exclusion amount is set to be reduced by 1/2 on January 1 of 2026. Further, there has been a number of legislative proposals to reduce that amount down to perhaps a flat dollar amount, perhaps $3.5 million, maybe $5 million. None of those legislative proposals have come to fruition yet. But either way, what this exclusion does is it exempts the first $12 million of your total lifetime gifts plus your estate at death from the gift and estate taxes of 40%. In other words, that 40% estate tax typically only kicks in once your combined lifetime gifts and gross estate exceeds $12,060,000. However, even though that creates a threshold, it's not applied as an inline subtraction or deduction. Instead, it's applied as what's known as an applicable credit equal to the amount of estate tax that would be paid on the $12,060,000 under the estate and gift tax rate table. So, under the $12,060,000 exclusion, you essentially take a tax of $345,800 on the first million plus 40% of the amount over $1 million, so 40% of $11,060,000. That's going to create your estate tax applicable credit. So what the anti-clawback regulations affect is the amount and calculation of that estate tax applicable credit by affecting what exclusion actually counts towards that credit amount. So what happened, a quick timeline, is back in 2011, the estate tax was slated to possibly go away or sunset back to its previous amount from 2001-2002, which would have reduced the exclusion down to $1 million. So tax legislation in 2011 increased that amount to $5 million. And at the time had a sunset potentially a year out as well, which was later extended. But as part of that, there were a couple key features added. One was portability, where if a spouse dies and has not used a portion of their exclusion, it can be preserved for the surviving spouse. That preserved portion of the exclusion is known as the deceased spousal unused exclusion amount, which I know is a mouthful, but that's contrasted with the basic exclusion, which is the amount given to every single individual regardless of marital status. What we're concerned with today is just that basic exclusion amount, not any form of unused exclusion preserved for a surviving spouse. Now, as I mentioned, that exclusion amount by the Tax Cuts and Jobs Act was doubled to a base of $10 million indexed for inflation, but is set to be reduced by 1/2, including inflation adjustments, on January 1 of 2026. As we're going to see, the IRS estimates that might be around $6.8 million, but given the increase in the rate of inflation, it may actually be more. Now, prior to that sunset, over the last couple years, there's been a lot of legislative proposals to further reduce that exclusion amount before the sunset to some predetermined amount, as I mentioned. So that's driven a flurry of gifting activity. Now, the anti-clawback regulations look at the fact that this exclusion, if it's reduced, may affect the amount of the estate tax applicable credit that's available to offset your combined lifetime gifts and your taxable estate at the time of death. So what the anti-clawback regulations sought to do is not penalize anybody for using up exclusion during life if it's further reduced to a point where they have no exclusion left at the time of death to be used as an estate tax applicable credit. So lots of people have gifted assets over the last couple of years trying to take advantage of this high exclusion amount of 12 million and change in case it's lost forever in the future. And what the anti-clawback regulations do is they say that at death, your estate tax applicable credit will be based on the higher of whatever the exclusion amount is available under the code at your death, or if more, the amount of exclusion you actually use for lifetime gifts. That's how you get around being punished for this. However, under the anti-clawback regulations, which were finalized in 2020, there is a question about whether certain situations might be abusive. In other words, could you make transfers now that use up portions of your exclusion amount, but aren't really in the spirit or nature of true gifts? We'll look at some examples of those here in a few minutes, but for the time being, there's a new set of proposed regulations which carves out certain types of gifts which may be deemed abusive. And these generally will include gifts that are included in the gross estate at death. So if you make a gift of property, but it ends up being included in your gross estate, you may not get to use the exclusion amount that was credited towards that gift as applicable gift tax credit. And as a result, at the time of your death, your estate tax applicable credit won't be based on any portion of the exclusion that was used for those lifetime gifts. So in other words, even though the intent was to use the exclusion before you lose it, if the asset is included in your gross estate that you use that gift tax exclusion for, you will still end up losing it if these proposed regulations are finalized. Now, in order to get there, you need to understand there's a bit of a mismatch. That you can make gifts and maintain certain benefits from those gifted property or gifted assets, and you can maintain control over those gifted assets as well. In either case, the IRS will include those gifted assets in your gross estate, as we'll look at in greater detail in a few minutes. But nonetheless, even if the asset is included in your gross estate, the IRS still treats it as a completed gift, which at the time of the gift would use some gift tax exclusion offset in the form of a credit, as we talked about earlier. That mechanism is not affected by any of these proposed regulations, but there's still a mismatch in terms of timing as to what exclusion ultimately applies at the time of death when it's time to calculate your estate tax. Do you get credit for the exclusion that was used for the gift, or are you stuck using whatever the exclusion amount available at the time of your death is, even if it's reduced prior to your death? To better see a visual of this illustration and the cost, your estate tax is really based on two buckets. One is your gross estate, which is everything you own or that you're treated as owning at death. The standard for the value of assets in the gross estate is their fair market value at either your date of death or at an alternate valuation date, which is 6 months after date of death. The entire purpose of gifting property is usually to remove the growth of that property from your gross estate. So lifetime gifts will typically be included in this green bucket, the adjusted taxable gifts bucket. It's called adjusted because some assets that you gift during life is exclusion before it goes away, or at least it used to not matter, but the IRS is concerned with these types of transfers because if you make a transfer where you retain economic benefit or control during your lifetime, what the way the IRS sees it is that's a transfer that even though you're treating it as a gift on paper, it's more in the nature of a testamentary transfer that would have been made at the time of your death. Now, the IRS has a mechanism under the Internal Revenue Code, as I mentioned, to pull assets into the gross estate, which are testamentary in nature, typically because of that retained economic benefit or control. So ultimately, the intent here is that any transfers that are testamentary in nature, the Treasury regulations reason, should be subject to whatever the exclusion amount available at death is, regardless of whether it actually used any lifetime gift tax basic exclusion. So that's the outcome here, that's the intent, and that's the why behind this. Now, Now, as I mentioned, portability is not affected. You can make portability elections and preserve unused exclusion for a spouse, and any unused exclusion can be applied towards gifts or towards the estate, and none of the gifts that we talk about today are going to affect the portability election or the use of a deceased spouse's unused exclusion amount. So portability elections are not affected. However, the new regulations work in a very special way by carving out an exception to the exception, which basically says certain types of transfers, if they're included in the gross estate, can't be counted when you consider whether the higher of the basic exclusion applied to gifts or the basic exclusion available at death determines the estate tax applicable credit. So what the special rule carves out are really 3 or 4 key areas, one of which we're just going to barely touch on but not dive into in great detail because it's rare that it applies. But we're going to look at 3 in great detail today. One is if you make a transfer that's subject to code sections 2035 through 2038, then that transfer will not count towards determining what portion of the basic exclusion you might have used for lifetime gifts. Similarly, if you make what's known as a donative promise, where instead of gifting assets to somebody, you instead maybe gift them a promissory note enforceable under state law where you promise to gift them assets in the future, that type of gift also will not count when it comes time to determine if you've actually used gift tax basic exclusion amount. And then finally, if you make any of these types of transfers but then relinquish your interest, in other words, you give up the economic benefit or control within 18 months of death, then the IRS will still disregard that type of transfer. Now, if you heard that 18-month thing and thought, well, under 2035, isn't there a 3-year look back as well? There is, but I'll explain the difference between the two in a second. Now, there's one other category of transfer where if you make a transfer subject to code sections 2701 or 2702, which typically deal with retained interest trusts that grant an annuity or unit trust interest, or certain transfers of business assets that are capitalized to provide a frozen value and appreciating value class of equity ownership, there are ways you can give up that retained interest and get a reduction in your gift tax liability or an adjustment to it. There are certain clawback mechanisms there that we're not going to get into in great detail today. So what we're really concerned with are the transfers subject to code sections 2035 through 2038 and transfers of a donative promise. Those seems to be the greatest areas of attack. Now, for those of you who wanted to or had the question about the reconciliation of this 18-month look back versus a 3-year look back, the difference is that the 3-year look back is a gross estate measure. So what that says is that if you make a transfer where you retain an interest under code sections 2036, 2037, or 2038, but you give up that interest other than as a transfer for bona fide or other than as a bona fide sale, then if that happens within 3 years of death, the IRS disregards it and treats it as if you still hold that retained interest at death. That's designed to discourage deathbed planning and deathbed relinquishment of certain retained interests that would create a testamentary style transfer. We'll contrast that with the 18-month look back, which is a basic exclusion measure. So the 3-year look back was a gross estate measure. The 18-month look back is a basic exclusion measure, which functions the same. It says, have you relinquished one of these retained interests within 18 months of death for less than full and adequate consideration? And if you have within the 18 months, then the IRS disregards it and says they're still not going to count that gift towards your use of basic exclusion when calculating your estate tax applicable credit. Now, there's one quick note I want to make before we dive into some specific examples, which are going to kind of illustrate some of the problem transactions within this new set of proposed regulations. One is with family partnerships and LLCs. So for those of you who've followed some of the tax court cases of the last few years, this is an area that's been heavily under attack by the IRS, where they look through a family partnership and determine that if it doesn't pass the bond guard test, which assesses whether there's a bona fide sale and whether there's a valid non-tax reason for creating the partnership, then essentially the IRS could disregard the partnership and treat the funding partner as if they were still the owner of the partnership assets based on their date of death fair market value, regardless of what the partnership equity interest ownership might be. So this type of anti-clawback, anti-abuse rule is going to affect partnerships as well, because not only might you end up with code sections 2036 or 2038 applying to a family partnership, but you also may lose the ability to use basic exclusion amount for gifts of partnership interests in a family partnership during life. Now, I also want to mention that these are just proposed regulations. They've been published for public comment, but none of them have been finalized. These could change, but for the time being, it's important to consider certain gifting transactions that might be abusive in the eyes of the IRS and which might not allow your client to use their basic exclusion amount before it goes away. We're going to illustrate a couple of these here. Example one, we're going to take a situation where maybe a client creates a grantor retained income trust, a GRIT, by putting in their full exclusion amount of $12,060,000 in 2022. Essentially, the client creates this trust but retains rights as a beneficiary, so the client can get income and principal in the discretion of the trustee, who may be different from the client. But either way, when the client dies, that retained benefit will cause the assets of the trust to be included in the client's gross estate at its date of death fair market value. Now let's further assume the client is gifted into this trust. They've used their full $12,060,000 basic exclusion to shelter the gift tax on that gift. Then they die in 2026 after the sunset of the basic exclusion amount, where it's reduced by 1/2. Assuming that the inflation adjustments over the next few years reduce that to $6.8 million, we need to look at the effects of that type of gift. So what happens? Well, as I mentioned, the full value of the trust is included in the client's gross estate. But the question is, what is their estate tax applicable credit against the estate tax generated by both their gross estate and that trust that's been pulled back into the gross estate? The anti-clawback rule says typically it would be the greater of the basic exclusion used during life for gifts, which would be $12,060,000, or the amount available at death, which is $6.8 million, according to the examples in the new regulations. In this case, however, since the property is included in the gross estate under 2036, what the new regulations say is that you can't count any of that $12 million exclusion that was used during life. No matter what, the client in this case is stuck using the $6.8 million exclusion that's available at death to determine their estate tax applicable credit amount. The result? Assuming a rate of 40%, there's an increase in estate tax of $2.1 million simply by virtue of having made this gift. So what can the client do? In this situation, what they could do is maybe relinquish their retained beneficial interest, but you need to note, if this happens within 3 years of death, the IRS will disregard that relinquishment of interest. And if it happens within 18 months of death, the IRS will still disregard that relinquishment for purposes of determining the basic exclusion amount. So you can go the relinquishment route, but the client has to live at least 18 months beyond that, preferably 3 years. And even then, that relinquishment may be a taxable gift, which, if the client has used up their full exclusion amount, may end up subject to gift tax paid out of pocket. So the client could do nothing and hope these regulations don't pass, but that may not be a good outcome for you if you are the attorney who has advised them to enter into this type of transaction. The next problematic transaction would be a situation where maybe a client makes a promise to make a gift of $12,060,000 to their child, writes a legally enforceable promissory note, but hasn't actually paid off the note at the time of death. Let's assume again the client dies in 2026 after the sunset. So once again, typically you would get to use the greater of the $12 million, which was applied to this donative promise as a lifetime gift, or the amount available at death of $6.8 million as the exclusion to determine our estate tax applicable credit. However, in this case, since a donative promise is targeted by the regs as being one of these abusive types of transactions, what happens here is that the IRS disregards the use of basic exclusion for this lifetime gift, and the client is stuck with an exclusion of $6.8 million for purposes of determining their estate tax applicable credit amount, once again resulting in additional estate tax of $2.1 million. So what can the client do? Well, the most obvious answer would be paying off the note prior to death. Now, the question is, does this 18-month look back apply to the payment of the note? The regs aren't clear on that. Presumably, they shouldn't, because payment of the note is equivalent to a bona fide sale settling out the note. However, it could still be the case that if the note isn't paid in full, there could be a part settlement, part gift, which still could affect that 18-year or 18-month look back. What the client could also do is maybe ask the child to forgive the note, but keep in mind, when the child does that, that's a gift back from the child to the parent. That's a bad outcome too. And the client could do nothing and then maybe pay the estate tax or roll the dice on whether the regs will be enacted. But once again, that's a bad outcome if the regs are enacted and you're the practitioner who is advised this type of transaction. Next example, we're going to assume that a client sets up a zeroed out GRAT this year, then dies in 2026 after the sunset. Well, this is the type of transaction where the GRAT is included in the gross estate if the client doesn't outlive the term of the GRAT. Now, it's rare you'd have a zeroed out GRAT that has such a long term, but that's still a possibility. But I want to note here that there is an exception under the regs that says that if the taxable gift is 5% or less of the total value of the transfer, this special rule doesn't apply. And that's the case here with the zeroed out GRAT. Since it's zeroed out, that means the taxable gift value was zero. So regardless of inclusion in the gross estate under Code Section 2036, this rule will not apply. But I want to mention either way, this is still a wash, because the fact that the GRAT was zeroed out means that there was no gift tax basic exclusion amount used to shelter the gift to begin with at the time of the grantor's gift to the GRAT. So, thank you for joining me for today's presentation. I hope this added value. I hope it gave you some ideas on what you should be doing for your clients and maybe shouldn't be doing for your clients, and fixes if you have a client who has pursued one of these problematic types of gifting transactions. If you have any questions or topic suggestions, you can email me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you for joining me for this presentation, and I look forward to seeing you in my future content.